Before we begin, let's walk through our webinar platform together. Each of the buttons at the bottom of your screen relate to sections in the ON24 console. The speaker view is where you will see our presenters throughout the webinar. The slide view is where you'll see the accompanying slides. Our poll questions will also appear in the slide area. Be sure to click directly on the slide to answer poll questions throughout the webinar. You can resize these widgets for a larger or smaller view. You may follow along also with a PDF version of the slides that can be found in the related content widget. The CPE criteria section details the requirements you must meet to receive full credit for CPE in this session. To obtain CPE, you must do two things. First, be on the live webinar for at least 50 minutes, and second, respond to 3 of the 4 polling questions that will appear throughout the presentation. You can track your viewing progress in the Earn CPE widget on your screen throughout the webinar. By registering for today's event, you will automatically receive an email after 24 hours with a link to download the slides and a link to view the recording. Additionally, if you meet all the criteria and qualify for CPE, a link to your CPE certificate will be in that email as well. Please remember that it does take 24 hours for that email to be automatically generated, so look for it sometime tomorrow afternoon. For CPE-related questions, please reach out to cpe@yptc.com. In the related content section, you can access any accompanying materials for this webinar. This includes a PDF copy of the slides and many times will often include related resources. Reactions from our audience throughout the webinar will float along the console screen. Use the Q&A section to ask questions directly to our speakers throughout the presentation. In the speaker bio section, you can find more about our presenters, including their contact information. If you need technical assistance, please use the help button below. Many times, technical issues can be resolved by opening the webinar in Google Chrome or refreshing your browser. Finally, the evaluation button contains our post-webinar evaluation survey. Here is where you can share your commentary and feedback on the presentation. We hope you enjoy our free webinar. Now, let's get into today's topic. Hello, everyone, and welcome to Spring into Stability, exploring cost allocations and a NICRA amid funding uncertainty. We are so grateful to have you with us today, and I'm going to be moderating today's conversation, so I'll start off with a few introductions. And we're just so grateful to have you here. So Your Part-Time Controller is a professional services firm that specializes in nonprofit financial management with over 30 years of experience. Our services include accounting, reporting, data visualization, and best practices, just to name a few. And we have over 800 staff helping close to 2,000 clients throughout the United States, as well as clients in several other countries. So my name is Carly McIntyre. As I mentioned, I'll be moderating today's conversation, but I'm really excited to share is our expert presenters, and I'll pass it over to them to introduce themselves.
Thanks, Carly. Hello, everyone, and thanks for joining. I am Hatsie Cutshall, and I'm currently the director of YPTC's new Government Awards Management Department. I've been with YPTC for more than 13 years, and I've had the privilege of leading teams in DC, Phoenix, and most recently New England. Prior to coming to YPTC, I was the CFO for 2 largely federally funded nonprofits, where I learned the rules that govern federal awards long before there was even uniform guidance. Along the way, I've helped many organizations apply for and administer negotiated indirect cost rate agreements, and I'm excited to have the opportunity today to help clarify what can be a very confusing topic.
Hello, I'm Melanie Yeager. I'm an associate at YPTC, where I have been dedicated to serving nonprofit clients since January of 2020. With 15 years in grants management roles with various nonprofits, I have gained extensive NICRA experience with cognizant agencies such as DHHS, DOL, the U.S. Department of Education, NOAA, and HUD.
Well, thank you, Melanie, and thank you, Hatsie. We have the slide in our download copy of the slides, so feel free to tune into that and check about obtaining CPE credit.
So our session today is really designed for those who manage or receive federal funds, particularly anyone who's newer to cost allocations or likewise looking to better understand the NICRA process. We'll be covering a lot of practical content, from simplifying common allocation methods to clarifying when and why a nonprofit might pursue a NICRA and what that process looks like. So our learning objectives for today are to describe and illustrate common cost allocation methods, define a negotiated indirect rate agreement, which is that NICRA, and related guidance and terminology, list reasons why or why not nonprofits might apply for a NICRA, and finally outline the typical documentation requested when preparing a NICRA proposal. If, again, as I mentioned, if you'd like to follow along more closely, you can download a PDF of the slides from our related content widget. You can also find a helpful collection of resources and links at the end of that deck, that PDF deck. So be sure to grab that as well. And we're offering this session because many nonprofits either have a NICRA that needs renewing or they're considering applying for one for the first time. And while this topic can feel complex, Hatsie and Melanie are here to break it down with real-world tips and guidance to help strengthen your financial foundation. So feel free to submit questions throughout the way in the Q&A widget. We may not get to every question live, but of course we'll review them afterwards and create follow-up content to address the most common themes. And of course, you can always reach out to us here at YPTC. We're here to help. So with that, I'll turn it over to Hatsie to kick things off.
All right, thank you, Carly. Again, before we can talk about NICRAs, we need to talk about cost allocations, which is really how the math works. And you may be wondering, why is that important here? Well, it's because a NICRA proposal is essentially a detailed description of an organization's cost allocation plan. What is cost allocation? If you're not an accountant, this may be a new term for you. In simple terms, cost allocation is the process of spreading shared expenses across activity centers, departments, or programs. Shared costs may include insurances, IT services, supplies, and similar types of expenses. In practical terms, spreading costs usually means making journal entries by the accountants to reclassify costs to different cost centers. If your accounting software has a cost allocation feature, those reclassifications can be automated to save time and aggravation. Please note and remember that costs can be both direct or indirect. Direct costs are just what they sound like. They're directly identifiable to a specific program, easily identifiable, while indirect costs really are not. Indirect costs benefit more than one objective, program, or activity, and can't be readily identified to just one. Think about insurances, for instance. Indirect costs that are not allocated to a program function are part of our overhead costs, which is, in most cases, just another term for indirect costs. Please make note that direct costs also sometimes need to be allocated. As an example, if you work with a Head Start center, you likely buy classroom supplies in bulk, such as markers, crayons, or paper. The costs of those classroom supplies are considered direct costs since they're used in the delivery of the program offered by the Head Start Center, and those costs might be attributed based on the number of students enrolled in each classroom. That's a common approach. Most organizations should have a cost policy outlining their cost allocation methodology. As we will see, payroll and related expenses are best allocated based on time and effort quite often, and facility-related expenses are allocated based on square footage quite often. This covers usually about 85% of most nonprofit expenses. So why do we allocate costs? Seems like a lot of work. Cost allocations are actually required for financial reporting under GAAP, generally accepted accounting principles. They're also required by the IRS on the Form 990 that for 501c3s and C4s must report expenses by their functional nature. So cost allocations are required to attribute shared costs to the correct functional categories. Additionally, some funders require it. All federal cost reimbursement awards require a cost allocation policy of some sort. When you receive federal awards for the first time, nonprofits are often required to submit a proposal and negotiate an indirect cost rate agreement to ensure that indirect costs are allocated fairly and equitably across all cost centers. Some agencies require a NICRA in lieu of the de minimis. This is known, this NICRA, the Negotiated Indirect Cost Rate Agreement, is why we're discussing this idea. But regardless of these other reasons, cost allocation is really necessary to understand the true costs of the elements of your business so that you can perform effective and useful business analysis. So now that we've reviewed why cost allocation is necessary, let's talk about allocation methods that you might use. And just remember that any methods used should be reasonable and applied consistently. However, certain methods work best for some costs, other methods for other costs. Management should select the method that fits the expense type. Common methods include percentage of time and effort, estimates of employee time, as well as FTEs, which are commonly used for cost items also related to the number of employees, regardless of salary, things such as telephone or office supplies. Square footage is often used for building-related expenses like rent, utilities, and there may be other key performance indicators that make sense in your organization, such as the number of students in each class, if you're teaching. So, we're talking about a cost allocation approach. What's the best way to develop that? Here's a step-by-step approach you might consider. First, identify the costs that need to be allocated. Look at your chart of accounts. Identify the types of expenses that can't be attributed directly, and in your analysis, include every active expense account that needs to be within your chart of accounts. Then categorize those expenses. Break down the costs as either direct or indirect. And I realize that costs like supplies may be direct sometimes and indirect at others. Once we've narrowed down the indirect costs that should be allocated, you'll need to identify how those costs will be allocated. Then choose an appropriate allocation base for each category of indirect costs. Those common bases that I've mentioned, I'll remind you here, might include the percentage of time, salaries, or square footage. Then create the formulas to do the math. For example, if you're allocating rent and utilities, if you've got a program that occupies 30% of the total office space, then you might allocate 30% of rent and utility costs to that program. Now, I do know that many organizations can't determine how much space a particular program occupies. In many organizations, every program works in space, in the entire space. So this allocation method may not be suitable for every organization. Then implement the methodology. Apply the allocation formulas to your financial data every month or at least quarterly. Make sure that all the staff involved in understanding the process know what's going on, as well as the importance of accurately tracking and reporting costs. Keep materiality in mind. For insignificant amounts, it may not be necessary to go to extreme lengths. You don't want to spend so much time allocating pennies that you fail to meet key reporting deadlines. And then review what you've developed periodically. As your programs expand, contract, or change, you may need to adjust the allocation bases or formulas periodically. Review the cost allocation methodology regularly, at least once a year, to make sure it remains appropriate and makes sense for your organization. And this is also the hardest part of developing an allocation plan or a NICRA. There's really no one right way to do it. It involves a lot of judgment. A couple of other helpful tips. You want to make sure that whatever methods you're using conform to the expectations of your funders. It's particularly important if you're receiving federal and other types of government grants that may have strict rules regarding cost allocation. If your allocation methods change significantly, you probably should touch base with your funders to make sure they're okay with those changes. Sometimes major changes will require a budget revision. And then communicate. Communicate with your leadership, all your stakeholders, including program managers, the executive team, the board of directors. Keeping things transparent ensures their buy-in, gives them an opportunity to ask questions as well as understand why and how we do these allocations. Here's an example, an illustration of a spreadsheet that you might use to allocate costs. In this example, we've got an ABC nonprofit that's using total salary percentages to allocate its group of identified costs. So up at the top in this first gray line, we've calculated how much of total salaries the art department uses, education, empowerment, and so forth. And down the bottom, sort of partially to the left, here's our list of health benefits, payroll expenses, our allocable costs that we're going to distribute based on those percentages. Remember that these costs should be listed and identified within your entity's cost policy and described as indirect or allocable costs, as well as how they're allocated. So we've done the math. You can't see the formulas, but if you want to check me on this, we've allocated, for instance, health insurance benefits across the various departments using the percentages that we developed up above, and then we ran the check totals down the right side. Just as a tip, there are programs such as Cost Allocation Pro that can help you automate allocations like these. They can track allocations by account and also even by individual employee if you need that level of detail. And they do create the backup support that you'll need for your grants, your funders, your auditors. Some do's and don'ts with allocations. We've mentioned it before, but do document what you end up deciding to do. You want to create an audit trail and a roadmap for future accounting staff, as well as current staff that may just need a refresher from time to time. Document those policies, keep them up to date as things change, and automate wherever possible. We find ourselves doing a lot of this work in Excel, but there may be allocation tools in some accounting software that can save a lot of time, and there are add-on applications that can save time as well. What you don't want to do is misclassify costs that really belong in management in general. So for example, human resources really should never be allocated to any specific program. They're management in general. You also don't want to use groupings or categories, terminology that really only makes sense in your organization. Remember that you've got people outside the organization reading these reports at times. And you also don't want to modify your allocation methods to fit a funder's budget. And here's our first polling question.
Thank you, Hatsie. So our poll is loading and it should be on your screen in the slide area. Why are costs allocations important? So know that you will need to click directly on the slide area to respond to this poll. You may need to scroll down to press submit, but are they important because they're required by FASB and the IRS? Do they provide good management information? Did the auditors tell you to do it and that's why they're important? Or maybe just because it's fun? Is it all of the above or just A or B? And I do see in the chat here that there are some people experiencing some issues with the slides and seeing them. So if you're not able to see the slide area, we always recommend refreshing your browser. And if the issue continues to persist, then please just download the PDF version of the slides in that related content widget and follow along that way. So it looks like we have about 80% complete. I'm going to go ahead and move on. There will be 3 more polling questions throughout today's session. And it looks like most people found that they're required, and it's good management information, just like what you spoke to, Hatsie. So thank you for giving that really clear basis for the rest of the session. It looks like people are listening and engaged. So thank you for that.
Okay, so now you might be asking the question, how can we set up our accounting system to make allocations better and easier? It all starts with the chart of accounts. Start with a good foundation and use the time-saving features in your software. And those might be factors in deciding what software you do use. Just as a note, we did a program on nonprofit accounting system design. There's a webinar from last November that's on our website if you want more information about this, but we'll show some examples next. When setting up your chart of accounts, what you don't want to do, you don't want to create another account every time you have a new program or funder. That's going to make your chart of accounts miles long. It will drive your accountants crazy. And it also makes it very difficult to compile the information you need for grant reports. So we prefer a very simplistic listing of the functional types of revenue, for instance, on the left, which again, the don't do this on the right shows how quickly your chart of accounts can expand. There are other ways of capturing information about the various grants and programs that we'll talk about in a moment. These charts were created in QuickBooks, and you can keep the same ideas in mind if you're working in other software packages. By using accounting segments, sometimes called sub-accounts or dimensions, and some strategic account numbering, you can roll them up into header accounts and achieve the same results. It's always a smart move to ask a skilled accountant to help you set up your chart of accounts. And now, because we see so many organizations using QuickBooks, we have an example on how to use QuickBooks Online for most effective chart of accounts design. The first setting you should be using in QuickBooks Online is the Classes feature. You want to find your QuickBooks account and settings, and from the Advanced menu, be sure to toggle on the Track Classes setting. Then create classes for your functional activities. These will generally be fundraising, general administration, and programs. Those are your header classes. If your nonprofit conducts membership activities, you'll want to add a class for that as well. And then within each header class, create subclasses for your major programs and activities. Don't create classes for funders or names of grants. There's another way to keep track of them. And just as a note, we took this example from a group that uses a class called To Be Allocated, which I've seen many organizations use. But in reality, if you run a P&L by class in QuickBooks, you'll see a column for a class called Unclassified. So there's really no need for that. It's really whatever works best for you. Here's an example of the type of report you can run by using the class feature. Here's a P&L or a statement of activity by class so that you can see revenue against expense by each class as each of the programs. You'll see fundraising, general administration, and the total added up on the right. And then if you want to do the same thing by customer or funder, use the Customers feature in QuickBooks. So from the Expenditures menu, you'll toggle on the Track Expenditures and Items by Customer setting. This will then, as mentioned, allow you to run a report showing revenue and related expense by funding source. And if you've got a funder that provides funds for multiple projects or programs, no problem. You can use both a class and a funder on each transaction. And with those basic cost allocation ideas in mind, now Melanie will talk through some basic concepts about NICRAs.
Okay, thank you, Hatsie. We are using a lot of terminology as we work through this program, and a lot of acronyms. This is the federal government we are talking about after all. The OMB, Office of Management and Budget, establishes the guidance that all other federal agencies must follow when managing the grants and cooperative agreements made by those agencies. Uniform guidance represents the rules and requirements for federal awards established by the OMB. Keep in mind that this is guidance, not regulation. The cognizant agency is the federal agency from which your organization receives the most funding as a direct or prime recipient. In the context of a NICRA, it is the federal agency responsible for negotiating and approving the indirect cost rate. The CFR is the Code of Federal Regulations. It codifies and organizes federal agency regulations into one publication. Once the federal agencies adopt that guidance, sometimes providing their own interpretation of those rules, it becomes regulation. The easiest way to access the CFR is online. The UG is housed in 2 CFR 200. It's a good idea to become familiar with all the subparts of the uniform guidance. I recommend you start with subpart E, the cost principles, which discuss which types of costs are allowable or unallowable on most federal awards. It's too much to take in with one sitting. I tend to go back to certain sections periodically to see what might have changed. Now, what is a NICRA? NICRA stands for Negotiated Indirect Cost Rate Agreement. It's an agreement between a federal agency and an award recipient that reflects an estimate of the indirect cost rate agreed to between the federal government and a grantee's organization. In layman's terms, a NICRA is a formal description of an organization's cost allocation plan and methodology. The NICRA is built on the audited indirect costs and fringe benefit expenses incurred by the organization. The rate approved in the rate agreement is a maximum that may be used during the period defined. How is the negotiation process started? With an indirect cost rate proposal. An indirect cost rate proposal provides the basis for an entity's NICRA. The proposal includes the documentation prepared by an organization to substantiate its claim for the reimbursement of indirect costs. This application and negotiation process assures federal funders that your organization has the capacity to manage its financial resources effectively and to attribute costs fairly and consistently. Note that these rules and processes apply to federal grants and cooperative agreements. For federal contracts, refer to the FAR, Federal Acquisition Regulations. It's important to note that allowing indirect costs on a federal award does not increase the total funding amount. For example, with a hypothetical $97,750 award and an indirect cost rate of 15% of direct costs, the direct costs would be $85,000 and the indirect costs would be $12,750. This rate determines how much of our indirect costs the award will cover, but does not increase the overall funding beyond $97,750. What is an indirect cost rate? An indirect cost rate is the ratio of indirect costs to the direct cost base. It is a tool used to determine the share of indirect costs that each program or activity should bear. It ensures a fair and equitable allocation of costs that cannot be directly attributed to a specific program or activity. Many organizations establish indirect cost rates to accurately manage the true costs of their programs, regardless of whether they are government funded or not. The calculation involves two main components: the numerator, which is the total indirect costs, and the denominator, which is the direct cost base. We will discuss the direct cost base in a later slide. Now, why would an organization apply for a NICRA? And there are good and bad reasons. Good reasons would include a nonprofit aiming for more federal funding can benefit from a NICRA, as it simplifies the support and approval process for applications. Another good reason is if a client has been using the de minimis rate but finds it costly because their actual indirect rate is higher. Switching to a NICRA can be financially advantageous. And then there are bad reasons. Simply because someone on the board thinks the organization should have a NICRA, or to follow a trend, applying for a NICRA just because other similar organizations have one, without a clear understanding of its benefits or necessity for your specific situation. Additional points: some federal and state funders require a NICRA, as it allows them to quickly calculate the appropriate allocation of indirect costs. Having a NICRA can increase the chances of federal award approval and streamline the entire budget process. And finally, how to apply for a NICRA. The cognizant agency is normally the federal agency responsible for reviewing, negotiating, and approving cost allocation plans and indirect cost proposals on behalf of all federal agencies. You may end up negotiating with an agency that does the work on a contract basis for several other agencies. For example, EPA pays the Interior Business Center to negotiate indirect cost rate agreements on its behalf. The indirect cost rate proposal contains documentation to substantiate the entity's claim for reimbursement of indirect costs. The approval process can take 6 months or more, especially now that many cognizant agency staff members are no longer in their jobs. After a rate has been agreed upon, it must be accepted by all federal agencies.
Thank you, Melanie. And now for our second poll question. As we're getting more into the conversation of NICRAs and the process there, what experience have you had with a NICRA? Do you work for an org with a NICRA currently, or is your organization considering applying for one? Maybe you've never really understood cost allocations or NICRAs, or are you just a fan of our monthly webinars and you like to come, which thank you for being with us. And I'm kind of curious, as people are submitting their responses, what are you two hoping that the main takeaway what they can walk away with from today?
Well, I think the main takeaway is that really be comfortable with the people from your cognizant agency, the negotiator especially, and ask questions because this is a subjective process, and it's up to interpretation, and having that clear communication is key in my mind.
Absolutely. And I hope people will also recognize the importance of understanding their indirect costs so that they can budget appropriately moving forward and make sure they cover their full costs.
I love both of those. And thank you for the responses. We're going to take a quick look, and we're pretty across the board here. We have some webinar fans. So again, thanks for coming back, and let's get into the rest of our discussion.
Okay. So the main source document used in the indirect cost rate calculation is the audited statement of functional expenses. This is an example of the statement of functional expenses for financial reporting in accordance with GAAP. It's important to note that auditors can no longer prepare the schedule for their audit clients, as they cannot audit a report they have prepared themselves. Using categories compatible with Form 990 is a best practice. This approach allows readers of the financial statements in Form 990 to compare the organization on an even playing field with others. The statement of functional expenses helps donors understand how their contributions are being utilized in the programs they care about, compared to other organizations. Note that the totals on this statement will agree to the total of expenses reflected on the statement of activities, the income statement. When we have expenses that are reflected on the statement of activities as a deduction from revenue, we still report those costs by their natural classification and function above, but then subtract them out in order for this report to agree to the statement of activities. Let's see if we can get this total to tie back to the Form 990. This is an example of the statement of functional expenses on a Form 990. It's too long to fit on one slide, so here's the top half, here's the bottom half, and here are the totals. Note that total functional expenses in an organization's audited financial statements may differ slightly from those reported on the Form 990. This is because some expenses must be included in the Statement of Revenue section of the Form 990. These may include rental expenses incurred for the production of rental income, cost of goods sold, or direct donor expenses from special events. Another item that is not included on the Form 990, but is included on the audited financial statements, is the value of donated services or use of facilities, otherwise known as in-kind expenses. Now, if you remember from the statement of functional expenses, the amount that we were going to tie back was $2,952,000. It doesn't appear to match, but not to worry. Form 990 has a reconciliation on Schedule D, Part 12. So in this example, we start with total expenses from the audited financial statements. We subtract in-kind expenses and arrive at total expenses per the 990 Statement of Functional Expenses. If your organization does not get an annual audit, you can prepare a NICRA based on the Forms 990, but you will need to take into account the reconciling differences. Now let's discuss allowable and unallowable costs as they relate to NICRA. As I mentioned earlier, allowable and unallowable costs are defined and explained in the Cost Principles section of the Code of Federal Regulations, specifically in 2 CFR Part 200, Subpart E. Allowable costs must be necessary, reasonable, and allocable to the performance of the award. However, the CFR does not provide specific lists of allowable and unallowable costs. Instead, it outlines general principles and criteria for determining them. Unallowable costs cannot be included in the indirect cost pool. These costs, such as entertainment, fines, lobbying, and certain advertising expenses, must be excluded from the indirect cost rate proposal to ensure compliance with federal regulations. However, unallowable costs can be included in the direct cost base for the purpose of allocating indirect costs. This includes costs like fundraising, which, although not allowable as charges to federal awards, must be treated as direct costs for determining indirect cost rates. For nonprofit organizations, the cost of activities performed primarily as a service to members, clients, or the general public, when significant and necessary to the organization's mission, must be treated as direct costs, whether or not they are allowable. These costs should be allocated an equitable share of indirect costs. Examples of such activities include membership expenses and lobbying expenses. Always read your award documents for how the awarding agency is interpreting the guidance. So even if uniform guidance says a cost is unallowable, such as advertising or meals and entertainment, if a federal award budget is approved with those costs included, they become allowable costs, but for that award only. Understanding the distinction between allowable and unallowable costs is essential for accurate and compliant indirect cost rate calculations. This ensures that your organization can recover the appropriate amount of indirect costs while adhering to federal guidelines. Next, we will discuss the direct cost base, which is the total of the direct costs used to calculate the indirect cost rate. The direct cost base is the denominator in the rate calculation. Understanding the direct cost base is essential when preparing a proposal budget and negotiating an indirect cost rate agreement. There are 3 allowable bases for calculating rates, unless you have a special rate. Those bases are direct salaries and wages, direct salaries and wages plus fringe benefits. And if you're unsure about what is included in fringe benefits, this pool typically covers costs such as payroll taxes and employee benefits. Organizations can choose whether to include the cost of paid leaves in the fringe benefits pool. Personally, I prefer to keep paid leaves in the salary lines as it simplifies budgeting and tracking. And the third allowable direct cost base is modified total direct costs, or MTDC. It's important to note that the calculated rate must be applied to the chosen allowable base and not to total costs or any other base. In a moment, we'll look at some examples of rate calculations using these different direct cost bases. But first, let's clarify what is meant by modified total direct costs. Modified total direct costs includes all direct salaries and wages, applicable fringe benefits, materials and supplies, services, travel, and up to the first $50,000 of each subaward, that is over the full term of the award period, regardless of the period of performance of the subawards under the award. It excludes items such as equipment, capital expenditures, rental costs, tuition remission, scholarships, fellowships, participant support costs, and the portion of each subaward exceeding $50,000. Other items may only be excluded when necessary to avoid a serious inequity in the distribution of indirect costs, and with the approval of the cognizant agency for indirect costs. I've put an asterisk by both equipment and rental costs because many cognizant agencies do allow small equipment costs as well as rent and occupancy costs in the modified total direct cost base. This method helps ensure a fair distribution of indirect costs across various programs and projects, avoiding disproportionate allocation to any single program. Reminder, the cognizant agency is normally the agency that awards your organization its largest dollar amount of federal funds directly. Modified total direct cost is the base used by those who opt for the de minimis indirect cost rate, which Hatsie will explain in the next section. As will be illustrated later, it also typically yields the lowest indirect cost rate, which some organizations prefer. A common misperception is that a higher indirect cost rate equates to a higher dollar amount of indirect costs. The slide demonstrates why that assumption is incorrect. In each of these examples, we divide the total indirect costs by the total direct costs to calculate the rates or percentages. As you can see, the modified total direct cost rate structure yields the lowest indirect cost rate due to the larger denominator. It also aligns well with federal guidelines and is often preferred by funding agencies, simplifying the grant application and management process.
Well, gosh, Melanie, since the MTDC base yields the lowest rate and creates a more favorable impression on many funders and donors, why would an organization choose using one of the other bases if those bases don't result in recovery of higher indirect costs?
Well, using the salaries and wages or salary, wages, and fringe base can be a strategic choice for organizations with large grants that are salary heavy. In practice, I've seen this approach ensure that indirect costs are allocated in a way that reflects the true cost structure of the grant, providing a fair and efficient distribution of indirect costs across the organization. Although the salary, wages, and fringe base results in a lower rate than the salaries and wages base, the salary and wages base is easier to manage and could be a good choice for many organizations. And if any of you have ever prepared a budget summary for a federal award, this format will look familiar. Note the line for indirect costs. And reminder, unless you request to include indirect costs in your award budget, many agencies will not allow them once the award is issued. If there are no indirect expenses in the approved budget, they usually cannot be charged or added later. So be sure to request indirect costs in your proposed budget. It may be worth asking the funder if you can revise the budget after approval, but we have seldom seen such requests approved if indirect costs were not initially requested. Not all funders are willing to cover indirect costs. However, once a rate agreement is negotiated, it must be accepted by all federal funders and pass-through entities, making subawards to other nonprofits. And Hattie, haven't we seen exceptions to this?
Oh, yes. In practice, and some of you here may have seen this, where, say, a state's Department of Education that was passing money through from the feds limited the indirect costs on those pass-through grants to a rate lower than the federal de minimis. In cases like this, you may consider reaching out to your funder or even to your elected representatives, though that latter approach may come with some political risk. You can also now report the situation to a newly formed office at OMB that is there to help enforce the guidance that requires the pass-through entities recognize the de minimis rate or an existing NICRA.
Also, while non-federal funders do not have to honor the federally negotiated rate agreement unless they are passing through federal dollars, changing allocation methods for different funders can raise red flags with federal funders. Therefore, it is crucial to use a consistent allocation methodology across all of an organization's funding sources. In our next section, Hattie will take a look at the various types of indirect cost rates.
All right, I know we're tight for time, so forgive me if I rush this, but we wanted to point out that there are a number of different types of indirect cost rate structures. You may all be familiar with the provisional rate. This is the type of rate that's issued the first time you apply for a NICRA at the beginning of that fiscal year. Once you complete the fiscal year and have an audit or a 990, you submit to finalize that rate, and you'll usually get an agreement that shows that final rate for the period in question, as well as 1 or 2 years in advance, and provisional rates. There are also fixed rates that apply when the nature of the work does not change significantly and typically used for projects of shorter duration. There's a carry forward feature to this rate, which means the difference between the approved rate and the actual rate carries into the following year. It's pretty clumsy. There's also a predetermined rate, which is used when financial data demonstrates reasonable assurance that the rate is likely to remain stable. So it's often used for states, very, very large entities. It's, again, a very difficult rate to use for small nonprofits, but a lot of states don't understand that. So you may see a predetermined rate set on what's passing through from the feds. And we've mentioned it, there is also the de minimis rate, which was increased from 10% to 15% of MTDC as of last October 1st. Note that you'll usually have the choice of which type of rate structure to use. Sometimes enabling legislation as well as agency preferences dictate the preferred structure, but I always recommend you push back, ask questions if you're asked to accept a rate structure that doesn't work well for your organization. We're going to start here to demonstrate how to use the de minimis rate. And once again, we're looking here at a compressed version of the statement of functional expenses. We're going to, this separates total direct costs from indirect costs for the period in question. And now we need to calculate MTDC because that's the base required to be used with the de minimis. So we've taken the total direct cost, that 7.264 number, and adjusted it to remove in-kind contributions, which have to be removed from both direct and indirect costs. Then we apply the 15% de minimis rate to the remaining $4 million. That's our modified total direct costs. And we end up with allowable indirect costs using that rate of $603,000 and change. And you'll note that that is below the number in our audited indirect cost column. And this is often the case and a reason to consider negotiating for a NICRA, a rate agreement. What other things should we keep in mind when choosing de minimis? You may now use de minimis even if you had a NICRA in the past. That wasn't always the case. If you do elect to use de minimis, you must use that for all your federal awards until a NICRA is received. You can't use a NICRA on some awards and de minimis on others. You can apply for a negotiated rate only if that option was requested or required during the original budget negotiation. So be sure to ask if the agency doesn't mention it. However, if your true rate runs a bit higher than 15%, you may be doing a disservice to your organization by accepting de minimis because it essentially means you're subsidizing the costs that the feds are not covering. So if my organization received a federal grant and the grant budget does allow for indirect costs, now what? You probably were able to use the de minimis rate in that preliminary approved budget. And if you ask for it, you may negotiate it for an indirect cost rate by submitting a proposal. If you do apply for a NICRA and the agency accepts that request, you must do so within 90 days of receiving your first federal award. We'll talk shortly about how and where to submit the proposal. And just, again, we have to emphasize that you need to be sure you bring up the option of indirect costs as you're going through your budget and proposal process. So here's an example of an indirect cost rate agreement. We wanted you to see what they look like. This is the first page of what can be a 3 or 4 page agreement, but this has almost all the information you really need. It will show you the type of indirect cost rate that the organization received. Were there any provisions? This talks about the base on which it was calculated, and how paid leaves and fringe and any other accounting aspects in the cost policy are unique to the organization. They're documented. So when you get this rate, before you sign it, make sure you review the agreement, make sure it's what you expected before you sign and return it. And now's our next polling question.
Thank you, Hatsie. So yes, this is our third polling question, and since we are getting short on time, we might run a few minutes over. So for those of you who need to leave, please feel free to submit this poll and then leave at the top of the hour. But there will be this poll and then one more poll left. So do you think your organization will apply for a NICRA? Yes, no, maybe? And I'm seeing a lot of really great questions come in through the Q&A. Remember, we will not be able to get to all of them today. However, we do create follow-up Q&A content. So follow along on our website and look out for those based on the common themes of what these questions are asking. And I do have one question for Hatsie and Melanie is kind of clarifying the difference between the indirect cost for purposes of the SOFE versus the NICRA indirect rate.
Well, as we alluded to, you start with the audited statement of functional expense, and it's usually the G&A column is the indirect cost pool, what you start with. And then you start adjusting for unallowable costs like gifts in kind or fines or other aspects that, again, reading the cost principles in the uniform guidance will help you determine what you really can't include. Advertising is another bugaboo that many negotiators they'll want to see detail of it. It's usually not an allowed cost unless it's included in the approved budget for your federal awards.
Thank you for that. I'm going to go ahead and advance. It seems like a lot of people might apply for a NICRA here. All right, I'll pass it back to you two to start to wrap things up, and I'll come back for a poll question in just a few minutes.
Okay. And next we will cover the proposal process. First up is the NICRA calculation exhibit that will be submitted with a proposal. This is a typical proposal template. The template may vary slightly by cognizant agency, but keep in mind the math is always the same. As previously discussed, the calculation exhibit is based on the audited statement of functional expenses and is typically prepared and submitted in Excel. A helpful DOL negotiator that I worked with for several years has emphasized that reviewing these statements in Excel significantly simplifies the review process. And accordingly, it is important not to lock down or hide the formulas in the Excel workbook. Key points to note: the schedule should clearly differentiate between direct and indirect costs. Fundraising expenses should be included in the direct cost base, even though they may sometimes be referred to as supporting costs on the statement of functional expenses. Dedicated columns for adjustments are included, with detailed explanations provided as footnotes on the schedules. This is where we subtract unallowable costs. Since this process can be subjective, professional judgment will be necessary. Also, keep in mind that you cannot rely on AI for this. I have been consistently given wrong answers when I use AI to ask what is allowable and what is unallowable. The negotiator may request supporting details and could identify additional unallowable costs. However, there's no need to worry. This is a negotiation, and the rate you propose may differ from the approved rate. Depending on the cognizant agency, other schedules may be required. These are included as separate tabs within the same workbook and may include indirect salaries and wages, detailed by position, a fringe benefits worksheet, contract and professional services, detailed by vendor, and detail of subawards. All supplemental schedules must tie exactly to the NICRA exhibit, which in turn must reconcile with the audited statement of functional expenses. And now for the calculation. This calculation is typically done at the bottom of the exhibit or on a separate tab of the Excel workbook. The numerator of the calculation is the total of the indirect cost pool, and the denominator is the applicable direct cost base. To summarize, these are the steps in the proposal process. Number 1, determine your preferred rate structure, do the math, assemble all materials, and package in the format that cognizant agency prefers. Many cognizant agencies will provide an indirect cost rate checklist for ease in packaging the proposal. Besides the rate calculation workbook, the proposal packet typically includes a formal signed cost policy statement, organization chart, signed certificate of indirect cost, signed lobbying statement, and a copy of the audited financial statements and single audit, which includes the schedule of expenditures of federal awards, or CFA. If the organization is not subject to single audit, then a CFA will need to be prepared and submitted. Number 2 is the submission. You deliver to the cognizant agency by their preferred means. Most I've seen are submitted via email. Number 3, the cognizant agency reviews, returns questions, and we discussed may require adjustments to the proposed rate. This process may take 6 months to a year. Keep in mind that it is perfectly acceptable to reach out periodically to the negotiator if you do not hear back within a reasonable amount of time. My experience has been that they are very helpful in letting you know where your proposal is in the process. A key point to remember is get to know your negotiator. They are there to help you through this process, not to punish you or your organization if you have questions. Note that if you need to submit a final report or a proposal for a new award, check with your contacts at the agency to learn whether they will accept a rate that is pending final approval. And finally, the cognizant agency will send a rate agreement as described by Hatsie earlier. Review to ensure the rate agreement matches what you expected to see, sign, and return. Here's a few FAQs. I won't read through them since we're pressed for time. Just keep in mind that there are exceptions to the 90 days. And number 1 there, I have seen exceptions when it is difficult to meet deadlines due to audit timing. Again, it's important to have a clear and open communication with the cognizant agency in such cases. Number 2, will subawardees need to apply for a NICRA? And sometimes, if they are receiving federal funding directly from at least one agency, if they are not, they can negotiate with a prime to use the prime's NICRA or another rate, or then they must be allowed to the option of using the de minimis rate as well. And number 3, these are just the items typically included in the proposal packet as discussed on the previous slide. And finally, here is an example of how to budget when you have a NICRA. This example uses direct salaries and wages as the base of the indirect cost rate. Step 1 is you subtotal the direct costs. Step 2, identify the cost base defined in the NICRA. In this example, it is direct salaries and wages. And step 3, multiply the cost base by the negotiated indirect cost rate. And there you have applied your negotiated rate.
All right. Great stuff. Thank you, Melanie, and thank you all for the patience. And we have our last polling question here. Would you like to see more webinars on this topic? I know that there was a lot of specific questions that you guys had on this topic, so I know that there's still a lot of curiosity in regards to how this applies to you. So let us know whether you'd like to see more on this. And then I'll just give this a few more seconds because I know that some people have had to drop off. But again, this is your last opportunity for CPE to respond to the poll. And with that, I will go ahead and move forward. And the answer is overwhelmingly yes, or maybe so. All right, Hatsie and Melanie, back to you guys to wrap things up.
Okay, well, I know many people feel a NICRA can be confusing and a little bit scary. It's nothing more than documenting your cost allocation plan and then putting that plan into practice. Whatever you propose and gets approved has to be used. So we talked about cost allocations. They're required by GAAP. the IRS and for better business management. We talked about pros and cons of using de minimis versus negotiating, and a little bit about how to apply for a NICRA. And keep in mind that the forms you'll use, the format is unique to every agency. So be sure you're using the format that your cognizant agency prefers. And I think that wraps us up. And here are some resources that we've collected that might be useful to you. If you can download the slides in a day or two once we post these to the website and have these readily available. Thank you very much for attending.